All right, let's talk taxes, because some pretty big changes are coming down the pike for 2025 and 2026. We're going to break down exactly what's new, what's different, and what it all means for your wallet.
So the big question is your paycheck actually about to change? Well, for most of us, the short answer is probably yes. And in this breakdown, we're going to dig into the two major reasons why.
And look, these changes aren't just happening out of the blue. They're being driven by two really key forces. One of them is something that happens every year, kind of like clockwork. The other? Well, that one's a brand new piece of federal legislation. Let's get into both of them.
Okay, first up, your paycheck is changing. And as we just said, there are two key drivers behind the new numbers you might be seeing.
On one hand, you've got the annual inflation adjustments. This is a yearly tweak the IRS makes to stop something called bracket creep. That's that annoying thing where inflation pushes you into a higher tax bracket even though your actual purchasing power hasn't gone up. Then on the other hand, you've got this new law. And yes, it's actually called the One Big Beautiful Bill. This thing is a big deal. It's extending tax cuts and rolling out a whole bunch of new deductions and credits.
All right, let's switch gears and talk about how tax brackets actually work. Because, honestly, to really get what these changes mean, we've got to be on the same page about the U.S. progressive tax system. It's probably one of the most misunderstood things in all of personal finance. So, the U.S. has what's called a progressive tax system. The easiest way to picture this is to think of your income filling up a series of buckets. The first bit of money you earn goes into the first bucket and it gets taxed at the lowest rate. Once that bucket's full, your income starts spilling over into the next one, which has a slightly higher tax rate, and so on and so on. Now, here's the absolute key takeaway. You do not pay your highest tax rate on all of your income. Nope. Just on the money that lands in that very top bucket.
Okay, so let's look at the actual numbers for a single person filing in 2025. These are our buckets. You can see that first, roughly $12,000 is taxed at just 10%. Then the next chunk of your income, all the way up to about 48 grand, is taxed at 12%. And it keeps going up from there. But to really see how this plays out, let's walk through an example.
Okay, let's imagine you have $90,000 in taxable income. Now, a common mistake is thinking you pay 22% on that whole 90 grand. But that's not how it works. Instead, we fill the buckets. The first part is taxed at 10%, the next chunk at 12%, and only the amount of your income that falls into that third bucket gets hit with that 22% rate. So when you do all the math and add it up, your total tax is just over $14,000. That's way, way less than if you'd paid 22% on the whole thing.
And this perfectly explains a key term you hear all the time, your marginal tax rate. All that means is the tax rate you pay on your very last, highest dollar of income. In our example, that's 22%. So when your friend says they're in the 22% tax bracket, they're talking about their marginal rate. They are not paying 22% on every single dollar they make.
All right, now that we've got the basics down, let's look at a really big change from that new tax law we mentioned. This one is all about a new break for seniors.
And it's a big one. The new law introduces a potential $6,000 tax deduction for individuals who are 65 and older. This is a pretty significant piece of relief, and it's aimed squarely at helping seniors deal with today's rising costs.
So who actually qualifies for this? Well, it's pretty straightforward. You have to turn 65 by the end of 2025. And there are some income limits to get the full amount. For individuals, your income has to be below $75,000. But here's the part that's a real game changer. You can claim this new deduction even if you take the standard deduction. That is huge. And right now, this new break is set to run all the way through the 2028 tax year.
And this isn't just some small financial footnote. Experts are really taking notice. Bill Sweeney, who's a senior vice president at AARP, put it this way. This is designed to give 4 years of immediate relief at a time when older Americans are really feeling the pinch from high costs. Okay, for our last section, let's get practical and talk about lowering your tax bill. Because, knowing the rules is one thing, but using that knowledge to actually keep more of your own money, that's the goal, right?
And this brings us back to a really important distinction. Your marginal rate versus your effective rate. We already know the marginal rate is the rate on your highest dollar, the 22% in our example. But your effective rate, that's the number that really tells the story. It's your total tax bill divided by your total income. For our $90,000 earner, it was just 16.35%. See? That's the actual percentage of your income you paid in taxes. It's what you really pay, and it's almost always lower than your bracket.
So how can you actually get that taxable income number down? Well, here are 3 of the most common ways. First, maximize every single taxable deduction you're entitled to.
Think things like student loan interest or contributions to an IRA. Second, do the math. You've got to figure out if taking the standard deduction or itemizing your deductions is going to save you more money. And third, a big one, contribute to a traditional 401k. Every dollar you put in there lowers your taxable income for the year, right off the top.
So we've gone through the new inflation adjustments, we've touched on a major new tax law, and we've demystified how tax brackets work. It really all boils down to this one last question for you. Now that you know the rules of the game, are you sure you're making the absolute smartest moves with your money?